morning. Where should we begin? Should we begin with the rupee? Look at the way the rupee opened today, flirting with 80 against the dollar, the greenback currency. We've seen a reduction and a fall in RBI's own forex reserves, trending below $600 billion. So the question I have to ask you is, are all of you penciling in 80? Is this going to be the new normal, 79, 80?
So I think the volatility around the rupee, we need to first understand is actually a dollar story. It's more of coming from the strength that dollar is exhibiting across all the currencies globally. And basically what has been happening of late is that there has been a fear of recession. And you can basically, look at behavior of currencies in two ways when there is fear of recession takes over. One is there could be a safe haven demand, which is basically all the money flowing back to the US and US being the mother market, and that will be positive for the dollar. And the second way of looking at it is in the case of a recession or in case of a growth slowdown, global investors start chasing growth, and typically higher growth is available in emerging market countries and in countries like India, which actually stand to benefit when commodity prices fall. So I think there are two ways to look at it, but what is right now happening is a bit of both. I would say the dollar is strengthening against all other currencies, whether it is the pound, whether it's the euro or even the Japanese yen, because of differential growth perspective as well as differential interest rate policies across the various economies, and that is leading to a dollar strength. Against India, we have now the benefit of falling commodity prices and oil, which has now fallen yesterday substantially. Of course, we need to see to what extent it sustains at lower levels. That could be positive for India. But there are a few headwinds in terms of the widening trade deficit, the higher fiscal deficit, and the fact that the dollar is also strengthening across all other currencies also. So from that perspective, I think it's not an easy answer. While I would say that the base case is for the rupee to depreciate and go towards 80, 81 over the next 3 to 6 months, I would say that a risk to that view would be that if the international views were to change about the extent of the rate hike cycle, commodity prices fall further and oil falls and stays at an even lower level, that could end up being a little positive for the rupee.
What about the bond yields? When we saw 752, I remember all of us were thinking we would see some measures, some jugalbandi by the RBI as well as not block. That hasn't happened. And many of you are now looking and factoring in maybe a 10%, an 8% like of yield. How likely is that, especially without any intervention?
So I think a lot of things happened on the yields in the bond market as well over the last 1 month or so. We have gone from, predicting the US Fed going all the way to 4.1% by early next year to right now what is being factored in is just 3.3%. That's nearly 70, 80 basis points of rate hikes in the US, which is getting reversed. And we have seen US 10-year bond yields also, falling from 3.25 to 2.885, kind of reflecting this kind of a changing in scenario. And we have seen, as I said before, oil prices also falling, commodity prices falling substantially. Now, what's happening again is the risk of recession in developed markets, which particularly the US as well as the euro and the UK and the euro area, which is actually resulting in these expectations of earlier unwinding of the current restrictive monetary policy. And basically what this has done is to kind of now markets are kind of less worried about the ongoing geopolitical tension and now more and more looking at whether there is going to be an aggregate demand destruction. Locally, when you're looking at India, you can see incremental bites which are coming from the RBI and the MPC members seems to be guiding towards intention to kind of find a balance between growth and inflation concerns rather than focusing only on inflation. Also, with the fall in commodity prices, it definitely looks like inflation might have peaked, at least on a sequential basis last month. And if you really see, RBI also seems to be indicating that they are guided more by local growth and inflation dynamics than by the the Fed's hiking spree. So if we are to assume that the Fed's hiking path is much more steeper and the RBI's hiking path is a little shallower than that, then you can actually make a case to say that the short end of the yields has definitely priced in substantial amount of rate hikes and it's unlikely to kind of go up much more. But the long end is a different ball game because that's where the government of India borrows, and there is really heavy borrowing pressure which keeps coming in. So from that perspective, one would assume that the upside to yields from the current levels would not be more than maybe 20 basis points or so. If the oil price fall were to sustain. Of course, if oil prices were to go up, then this view would change. And if oil prices were to come down more, then I think a move even towards 720, 725 cannot be discounted.
Right. Prasanna, you also talked about how inflation has probably peaked and the tightrope central banks are walking. Given that your base case, do you expect a bit of softening in the rate upcycle, or do you think the pace of rate upcycle is going to continue?
So that's exactly the debate which is going on, and there are people who are on both sides of the debate. I would say that in a normal interest rate cycle, the Fed, for example, is always, played into market expectations and played into changing scenarios, and has, not done the full extent of the hikes that they have earlier, spoken about. But this time around, what is different is the fact that they had spoken about transitory inflation the whole of last year, probably delayed the hiking by too much, and because of which we are now in a soup where, developed market inflation is as high as 8%, 9%. So there is somewhere a feeling that we need to first look at targeting inflation, bringing it down, see actual data coming lower before, we slow down on rate hike. That seems to be the rhetoric coming from the Fed, at least so far. And so it's a $1 billion call. I really, actually, my base case would be for the Fed to go ahead and hike to around 375, and then probably look at incremental cuts in the first half of, towards this later half of the next calendar year. And from emerging market perspective, I think, for example, Reserve Bank of India, I'm sure will be looking at what's happening to the growth estimates globally, what's happening to inflation estimates, and if their view is also to come around that inflation has peaked and is probably going to come down, and also the impact of the earlier rate hikes would also play through gradually. I'm sure they will also, look to, kind of revise their rate expectations. In any case, I think the market today in India is expecting much more rate hikes than what the RBI is probably prepared for. So from that perspective, I think maybe some level of softening can happen from the rate hike perspective.
Sure. So before we let you go, Prasanna, let's also talk about the latest trade deficit data as well. While it's no surprise that it is widened, the number did come in as a little bit of a shocker than what economists were penciling in. Do you expect further widening of the current account deficit and the trade deficit, or would you say that the worst is behind us?
Yeah, so I think the recent trade deficit does show a little bit of widening, much more than what some of us were anticipating. It was kind of the poorest data from a trade deficit perspective that we have seen in quite a bit. And what it has done is we probably revised our, the yearly current account, the yearly trade deficit upwards by around $6 billion for the year. So we're looking at around $270 billion of deficit this year. And but then, as we speak, with the commodity prices falling and with oil prices falling, there is obviously a downside risk if the downward price sustains, and an upside risk if oil doesn't go lower. But what it does to the entire environment is that it's kind of indicated that there is a widening of the core trade gap, which is a non-oil, non-gold import, and as exports have softened on account of the global slowdown, but imports have actually increased on actually the strong domestic demand. So yes, these are widening. These are kind of troublesome times from trade deficit and current account deficit perspective. I mean, not that we didn't know about it earlier, but what is now more important is what's going to happen to commodity prices going forward. And if the fall were to sustain, like I said, these numbers can hopefully get a little better. But I suspect that with most of the oil price hike happening due to supply side reasons, and none of the geopolitical reasons and the supply side reasons are going away in a hurry, one fears that oil does not have too much of a downside below 100, in which case most of the street expectations of around 265 to $270 billion of trade deficit for the year should continue.